And I'm still a student. I am still learning today as much as I was learning 36 years ago when I started in the business.
Well, BlackRock, it's the world's largest money manager. It hit an all-time high of $11.5 trillion in assets.
If you could pinpoint what made this work in such a stunning way, what was it?
From a modest neighborhood, he grew up with hard-working parents. Nothing was handed to him, no golden parachute, no silver spoon. He worked his way up, proving himself at every turn. But success doesn't come without failure. After years of climbing the ranks in the financial world, he made a mistake. A $100 million mistake. For most, it would be the end of the road. Careers would collapse, reputations would shatter. But for him, it wasn't the end. It was the beginning. Instead of running from the failure, he used it as a blueprint to build something greater. A financial powerhouse that commands over $10 trillion in assets. Yes, trillion. That's more than the GDP of almost every nation on Earth. But this isn't just about money. It's about power. The kind that doesn't just move markets, but shapes economies. The kind of power that influences governments, impacts policies, and touches the lives of millions around the world. He's not a celebrity. His face isn't on magazine covers, but his reach? It's everywhere. Your retirement fund, your mortgage, your investments. Every financial ripple traces back to him. He didn't just learn from failure, he transformed it. He rewrote the rules of modern finance, turning a catastrophic loss into a revolutionary empire. So who is this man, quietly steering the global financial system? His name is Larry Fink, the driving force behind BlackRock. The story of Larry Fink begins in the sun-soaked suburb of Van Nuys, California, where he was born on November 2, 1952. This was a time when the San Fernando Valley was transforming from farmland into a bustling middle-class haven, a place where hard-working families sought the promise of a better life. For the Finks, a Jewish family navigating the opportunities and challenges of post-war America, this environment offered a space to grow and thrive. Larry's parents, Frederick and Lila Fink, each brought unique strengths to the family. Frederick owned a shoe store, providing for the family through his small business, while his mother, Lila, was an English professor at California State University, Northridge, whose passion for education and intellectual curiosity likely influenced young Larry. After graduating from high school in 1970, Larry left the familiar streets of Van Nuys and headed for the expansive campus of the University of California, Los Angeles. The Vietnam War was still raging, sparking protests across college campuses. Civil rights movements were demanding justice, and the counterculture was challenging traditional norms. Stepping into this charged atmosphere, Larry encountered a campus alive with ideas and the energy of change. At UCLA, Larry pursued a degree in political science, drawn to understanding governance and systems. The political science department offered a strong foundation in governance, international relations, and policy making. During his senior year, Larry enrolled in a seminar on real estate through UCLA's business school. The course introduced him to the complexities of property development and finance, sparking a new interest. Encouraged by this passion, Larry decided to stay at UCLA after graduating in 1974. He enrolled at the Anderson School of Management to pursue an MBA, specializing in real estate. Armed with his MBA in 1976, Larry Fink stood on the threshold of Wall Street, ready to make his mark. It was an exciting yet uncertain time. The US economy was in recovery mode, with the aftershocks of the oil crisis and inflation still reverberating. Financial innovation was taking root, but traditional banking still dominated. For a young man with big ambitions and a sharp analytical mind, the opportunities were immense. But so were the challenges. Larry's entry into the world of finance wasn't entirely smooth. His first major opportunity, an interview with Goldman Sachs, ended in disappointment. A misstep during the process cost him the position, and he left the interview room feeling defeated. Yet what seemed like a failure at the time would later prove to be a pivotal moment in his journey. Instead, Larry accepted an offer from First Boston, a New York-based investment bank with a solid reputation. The firm wasn't as prestigious as Goldman Sachs at the time, but it offered Larry something more valuable: a chance to learn and grow in the evolving world of fixed-income securities. He joined the bond trading department, a corner of finance that was just beginning to gain attention. Larry's background in real estate gave him an edge in the bond division, particularly in the area of mortgage-backed securities, a product that was still in its infancy. Unlike stocks, bonds were considered stable and less glamorous. But Larry saw potential in them. He understood that bundling mortgages into securities could create a new market with endless possibilities.
The bond market has evolved and changed, and it's continuing to evolve and change.
From the beginning, Larry worked tirelessly, immersing himself in the intricacies of the bond market. He wasn't content to simply follow the established rules. He wanted to innovate. Larry's sharp analytical skills and natural leadership quickly set him apart. By 1978, just 2 years into his tenure, he was promoted to lead the bond trading desk. It was a remarkable achievement for someone so young. Larry surrounded himself with a team of like-minded individuals. They worked long hours, often late into the night, perfecting strategies and analyzing data.
Here I am running this company now, not quite 25 years, and I still spend an hour a day studying the world and the markets.
The bond trading desk at First Boston became a hive of activity, fueled by Larry's relentless drive to succeed. Among his recruits was Robert Capito, a brilliant and ambitious colleague who would later become one of Larry's closest allies. Under Larry's leadership, the bond desk thrived. Mortgage-backed securities became a cornerstone of the business, generating massive profits for First Boston. By the early 1980s, the division was responsible for billions in earnings. Larry's success at First Boston catapulted him into the upper echelons of Wall Street. By 1981, he had been appointed managing director, and at just 31 years old, he became the youngest member of First Boston's management committee.
We were the most profitable division in First Boston in 1981, 82, 83, 84, 85. And what they did was they gave you more capital. We had no idea how we were making money. We had no technology to understand the risk.
In 1986, Larry's meteoric rise hit an unexpected and devastating roadblock. A miscalculation in predicting interest rate trends led to a catastrophic $100 million loss for First Boston.
And in 1986, we lost money.
I was so angry at myself. Now it drove.
You were angry with yourself.
I was just mortified at myself.
The loss wasn't just financial, it was personal. Larry had built his career on precision and risk management, but this failure exposed the limits of his strategies. The aftermath was swift and brutal. Larry's reputation, once untouchable, was now under scrutiny. He was no longer seen as the golden boy of First Boston. Though he wasn't fired, he was effectively sidelined, and his chances of ascending to CEO shattered. The man who had once been a rock star of Wall Street was now grappling with a level of humiliation he had never known. By 1988, Larry Fink had left First Boston, his reputation bruised by the infamous $100 million loss. But his resolve was unbroken. He could have walked away from Wall Street, retreating into anonymity. But Larry wasn't one to back down. Instead, he chose to rebuild, not just his career, but an entirely new way of managing investments. Larry's vision was clear. The financial world needed a firm that didn't just rely on gut instincts or isolated bets, but instead operated with precision, accountability, and a deep understanding of risk.
Our job is to provide risk management services to clients.
He had seen firsthand the devastating consequences of poor risk management, and he wanted to ensure that no client would ever have to endure the kind of losses that had cost him so dearly. Larry wasn't alone in this endeavor. His idea resonated with a close-knit group of colleagues and confidants who shared his frustration with the status quo. Among them was Ralph Schlosstein, a treasury expert turned investment banker who became Larry's trusted partner. The two had spent years brainstorming over early morning phone calls, discussing their shared dissatisfaction with the financial industry's lack of focus on risk management. Larry also reached out to his former team at First Boston. Ben Golub, a mathematical genius who had developed innovative risk analytic systems, became a cornerstone of the project. Barbara Novick, a formidable presence who had excelled in portfolio products, brought a no-nonsense approach to operations.
You can also build portfolios where you screen out companies. So more and more we're working towards a taxonomy that would differentiate what type of portfolio is it.
Keith Anderson, one of the top bond analysts from First Boston, joined to bolster the firm's expertise in fixed income. Larry and his team began sketching out the framework of their new venture. They envisioned a company that wouldn't just manage assets, but would act as a steward for clients, safeguarding their investments with cutting-edge analytics and disciplined strategies. They wanted to harness technology to create a platform that could dissect and understand every aspect of a portfolio. The next step was finding the funding to bring this ambitious idea to life. Larry's reputation was still recovering, and raising capital wasn't easy. That's when he turned to Steve Schwartzman and Pete Peterson, the founders of Blackstone, a rising star in the private equity world. Larry pitched his idea with unshakable conviction, emphasizing the need for a firm that prioritized risk management above all else. Schwartzman and Peterson were intrigued. They saw potential in Larry's vision and agreed to provide $5 million in funding in exchange for a 50% stake in the new company. Blackstone Financial Management, BFM, was born, operating out of a small office space in New York City. For Larry, this partnership wasn't just about money. It was a vote of confidence in his ability to turn failure into innovation. From the very beginning, Larry knew that technology would be the key to differentiating his firm from the competition. He tasked Ben Golub with developing a proprietary risk management platform that could analyze, model, and predict potential pitfalls in investment portfolios. They named it Aladdin, Asset, Liability, and Debt Derivative Investment Network, a system that would eventually become the backbone of BlackRock's operations. The first version of Aladdin was a humble affair, coded on a $20,000 Sun Microsystems workstation, crammed between a refrigerator and a coffee machine in their tiny office. The early iterations were rough, but the concept was groundbreaking, a platform that could break down complex portfolios into actionable insights, allowing clients to see not just their returns, but the risks underpinning them. Larry and his team worked tirelessly to refine Aladdin, often staying late into the night. The process was grueling, but the payoff was immediate. Clients were impressed by the platform's ability to provide clarity in a market often clouded by uncertainty. Within months, Blackstone Financial Management was turning a profit. Securing their first clients wasn't easy. Many investors were wary of Larry's recent history, and skepticism about his ability to deliver results lingered. But Larry's passion and the promise of Aladdin won them over. Pension funds, endowments, and institutional investors began to see the value in what Larry was building. A firm that could offer not just growth, but stability. One of the first major breakthroughs came when General Electric, GE, decided to entrust a portion of its portfolio to Larry's team. It was a test of everything Larry had promised, and failure wasn't an option. Over the next several months, the team worked tirelessly to manage the fund, applying the principles of risk management and analytics that had become their hallmark. The results spoke for themselves. The client saw steady growth with minimal volatility, and word began to spread. By 1989, just a year after its founding, the firm's assets under management had quadrupled to $2.7 billion. Larry's vision was no longer just a concept. It was a thriving reality. By the early 1990s, Blackstone Financial Management, BFM, was flourishing, but behind the success, tensions between Larry Fink and Steve Schwartzman were growing. their differing visions for the company's future became increasingly apparent. Larry believed that attracting top talent meant offering equity incentives, fostering innovation and loyalty. Steve, on the other hand, feared that this would dilute Blackstone's control. These philosophical differences created a rift between the two men that eventually led to a breaking point. In 1992, after months of tense negotiations, Larry decided to take action. He bought out Blackstone's stake in the firm with the backing of PNC Financial Services, and Blackstone Financial Management was reborn as BlackRock, a name that marked both a nod to its origins and a new chapter of independence. This was not just a business move for Larry, it was a leap of faith. Walking away from the security of Blackstone's established brand, he set out to build something that was entirely his own. Under his leadership, BlackRock quickly carved out a reputation in the fixed income space, and by the end of 1994, the firm was managing $53 billion in assets. It was clear that the gamble had paid off. By 1999, BlackRock had grown to manage $165 billion in assets, positioning itself as one of the largest asset managers in the world. But Larry had bigger plans. He wanted BlackRock to become the dominant force in global finance, and the new millennium marked the beginning of a transformative era. The year 2000, BlackRock focusing on laying the groundwork for global dominance. Its proprietary risk management platform, Aladdin, was rapidly gaining recognition. When the dot-com bubble burst in 2001, BlackRock's conservative approach and robust analytics tools helped its clients weather the storm, earning the firm a reputation as a steadfast partner in turbulent times. By 2002, BlackRock made its boldest move yet, going public. The IPO on the New York Stock Exchange provided the capital and visibility needed to compete on the global stage, signaling the firm's determination to expand its reach. Over the next few years, BlackRock diversified its offerings, moving beyond its fixed income roots to develop equity and alternative investment capabilities. The firm also deepened relationships with institutional clients, tailoring solutions for pension funds, insurance companies, and governments. By 2005, Larry Fink and his team recognized that true global dominance would require a stronger presence in retail markets and a broader international footprint. The opportunity came in 2006 with the groundbreaking merger with Merrill Lynch Investment Managers, MLIM. This $9 billion deal doubled BlackRock's assets under management to over $1 trillion, transforming the firm into a global powerhouse. The MLIM merger brought significant benefits. It strengthened BlackRock's presence in retail markets, expanded its international reach, and diversified its portfolio by combining its fixed income expertise with MLIM's equity capabilities, aligning operations, and leveraging its expanded offerings to attract new clients. With a strengthened global presence and growing assets, BlackRock was already envisioning its next big leap, planting the seeds for future acquisitions. The global financial crisis of 2008.
It was the worst day on Wall Street since the crash of 1987.
As financial institutions collapsed under the weight of toxic assets, Larry Fink's emphasis on risk management became a beacon of stability. BlackRock's Aladdin platform played a critical role in managing and unwinding distressed assets from institutions like Bear Stearns and AIG, cementing the firm's reputation as a problem solver. Despite the chaos, BlackRock seized opportunities, including the acquisition of Barclays Global Investors, BGI, in 2009. This $13.5 billion deal doubled its assets under management to over $3 trillion and included iShares, a leader in ETFs, propelling BlackRock to dominate both active and passive management. By 2014, BlackRock's assets under management had surpassed $4 trillion, driven by consistent client inflows and the explosive growth of iShares, which continued to lead the ETF market globally. During this time, Larry Fink began to emerge as a leading voice in corporate governance and sustainability, using his highly anticipated annual letters to CEOs to call for long-term value creation over short-term profits. This marked the beginning of BlackRock's foray into environmental, social, and governance, ESG investing, a strategy that would later become central to the firm's identity. Between 2015 and 2019, BlackRock continued its commitment to technological innovation and sustainability. The Aladdin platform gained traction, expanding its role in portfolio management. By the end of 2019, Aladdin had become a cornerstone of BlackRock's offering, solidifying the firm's reputation as a leader in risk management and investment technology. During this period, BlackRock also launched a series of ESG-focused investment products, cementing its commitment to sustainability and long-term value creation. By 2019, the firm's assets under management had ballooned to a staggering $7 trillion, positioning BlackRock as one of the most influential financial institutions in the world. As BlackRock entered the 2020s, Larry Fink's focus on sustainability took on even greater importance. In January 2020, BlackRock made a bold and public commitment to align its investment strategies with the Paris Climate Agreement. Larry's annual letter to CEOs emphasized the firm's determination to push for long-term sustainability. With a clear promise to reorient portfolios away from companies with heavy carbon footprints, the firm made a major shift in its investment strategy, pledging to divest from companies involved in thermal coal, signaling that BlackRock was fully embracing the shift toward a low-carbon economy. This move was part of a broader trend in the financial world, as institutional investors increasingly turned to environmental, social, and governance (ESG) factors to guide their investment decisions. By the end of 2020, BlackRock had become one of the largest investors in sustainable assets, and its ESG-focused funds had gained widespread attention. The firm also launched a number of new investment products designed to meet the growing demand for sustainable options, solidifying its position as a pioneer in the ESG space. In 2021, BlackRock further deepened its commitment to sustainability, launching new strategies to integrate ESG factors into its core investment processes. The firm also started actively engaging with companies to ensure they were meeting sustainability targets, recognizing the importance of pushing businesses toward responsible practices.
We're designing a portfolio that has better ESG or better sustainability metrics to it, and we're doing quite a bit of that. And then we have clients who are saying, I want to be rid of all the different old technologies.
2022 marked another milestone for BlackRock, as the firm took its ESG ambitions to the next level. BlackRock began to take a more active role in advocating for the climate-related disclosures and in encouraging businesses to adopt more transparent sustainability practices. The firm's efforts to pressure companies to adopt net zero emissions goals further enhanced its reputation as a leader in sustainable finance. Meanwhile, as the world adapted to new technological and financial trends, BlackRock continued to innovate. It increasingly turned its attention toward emerging technologies like blockchain and cryptocurrencies. Larry Fink, once a critic of Bitcoin and other digital currencies, softened his stance in the face of growing institutional interest in digital assets.
I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument.
In 2024, BlackRock took a significant step into the cryptocurrency market by launching a Bitcoin exchange-traded fund, ETF. This marked a pivotal moment in the firm's evolution, showcasing BlackRock's commitment to staying at the cutting edge of the financial world. By 2024, BlackRock's assets under management had surpassed $11.5 trillion, a sum that not only dwarfed the GDP of many nations, but cemented BlackRock's position as the world's largest asset manager. In a world increasingly focused on sustainability and technological innovation, Larry Fink's vision for BlackRock had come full circle. From its roots in fixed income investments to its leadership in ESG and its forward-thinking embrace of blockchain technology. Today, BlackRock stands as a testament to Larry's leadership, vision, and the enduring power of innovation. Larry Fink, now in his 70s, remains at the helm of the firm he built from the ground up. His journey, from a young man growing up in Van Nuys to becoming the leader of the world's largest asset manager, continues to inspire. BlackRock, under Larry's guidance, has not only reshaped the financial industry, but has also become a driving force behind the movement toward a more sustainable, technologically advanced, and responsible future.